All right, let's talk about something you've probably seen and maybe even scratched your head about on your investment statement. That term, mark to market. It sounds super technical, right? But really, it's all about one simple thing, knowing what your stuff is worth today.
You know that feeling, right? You log into your account, you look at a bond or some other stable investment, and the number is different from yesterday. And you're thinking, hang on, isn't this supposed to be fixed income? Why is it moving around? It's a super common question, and we're going to get right to the bottom of it.
So what's the reason behind those daily price swings? Well, it all boils down to this one big idea. Let's dive in and unpack it.
And here it is, mark to market. All it means is pricing an investment at what you could get for it if you sold it, like right this second. It's not about what you paid for it. It's not about what you hope it'll be worth at the finish line. Nope. It is purely a snapshot of its price in the market today.
Okay, here's the best way to wrap your head around this. Think about a house. Let's say you own a house. You're not selling it, you're living in it. But you know its value isn't static, right? The housing market goes up, it goes down. Your house's price is changing all the time, even if it's just on paper. You only actually make or lose money when you sell the thing. Mark to market for your investments? It's the exact same idea.
All right, so how does this play out in the real world, especially with things like bonds? Well, this is where it gets interesting because it's all about interest rates. Let's take a look at our first scenario. What happens when interest rates out there start to climb?
So picture this. You've got a bond, and it pays you a nice, steady, fixed rate. But then, the market changes. Interest rates go up. That means any new bonds getting sold now have to offer a higher payout to get people to buy them. All of a sudden, your older bond with its lower payout, well, it doesn't look quite as shiny anymore, does it? So for anyone to want to buy your bond, its price has to drop to make it competitive. That's marking to market. In action, the price gets marked down.
Now, this is the part you absolutely have to remember. Seeing that number dip on your statement can totally freak you out, but you haven't actually lost a dime. Not really. It's only a real loss if you panic and sell right then and there. If you just hold on to that bond until it matures, you get paid back exactly what you were promised. This is all just a temporary, on-paper thing.
Okay, so we've seen what happens when rates go up. Now let's flip it. What happens when interest rates start to fall?
You guessed it, it's the complete opposite. You're sitting there with your bond, chugging along with its solid payout, and now interest rates in the market take a dive. Any new bonds being sold now offer a kind of lousy return compared to yours. And suddenly, your bond looks amazing. It's paying more than the new stuff. It becomes a hot-ticket item. And what happens when something's in high demand? Its price, its mark-to-market value goes up. Now you're looking at a nice little paper gain in your account.
Okay, so we've got these numbers bouncing around, these paper gains and losses. But so what? Why should you even care? Well, it all comes down to one really important thing for you, the investor: transparency. Let's just tick off the benefits here, because they're pretty important. First, this system shows you the honest-to-goodness reality of your investment's value today. It gives you a clear, transparent picture of what your portfolio is worth. And remember the golden rule: it's not a real gain or loss until you actually sell. And this is huge for anyone in it for the long haul. If you just hold your bond until it's done, until it matures, none of these daily ups and downs matter for your final return. It's really just market chatter along the way.
So, at the end of the day, mark-to-market isn't some force that's creating profits or losses out of thin air. All it does is reveal the current value, giving you a much clearer picture of where you stand. Which leaves us with a final thought. A question for you, really. Now that you get how the daily price works, how are you going to look at your investments? Are you going to get caught up in the single photo from today? Or are you going to watch the whole movie of the journey?